Okay, everybody, first and foremost, I just want to thank everybody for taking a quick minute out of their day to join us on this webinar. What we want to tackle today is transparency, and you can see these three boxes, right? And essentially what we're doing is trying to illustrate and compare the transparency by type of lender that's in the market. You have the bankers, the brokers, and then you have the arbors of the world, which are like a non-delegated super broker. Okay, the bankers of the world, like the number one complaints I hear from loan officers is that what they don't realize is where all the money goes. They cannot see what the corporate margin is. The rates move day in and day out, but they don't know how much the company is making on every one of their loans. If they have a branch manager, they don't know what the branch manager is making on their loans. A lot of times what they'll notice too is that the pricing is different between FHA, conventional. So they don't get to see like how the margins are being tinkered with between the products. And really what it all comes down to is where is your money going, right? And then if you have to compete on a transaction, so you're out of the market, you have to go ask for a price exception, you don't necessarily know what your comp plan is going to be because you're having to erode that to kind of make concessions to be competitive. And then I think one of the biggest issues is that you don't know what the street level price is. So you're kind of pricing blind. So when you go out and price a deal out there to the public and you send it out to your, to your customer, you're just kind of holding your breath because all you can see is this pricing inside your bubble. You don't know what's out there and what you're competing against. On the flip side, though, there is a benefit when you're in the banking channel, right? You do get flexibility, right? You don't have to do this lender paid comp plan that's in the broker world. I will plug that when you're on the far right-hand side, you don't have to do that either. If you're over at Arbor, you have pricing flexibility as well. But when you move into the broker and super broker world, that's where you start to get true transparency. You get market transparency. You can see 70, 80, 90 different wholesale lenders and what they're pricing every type of deal on every day as it changes. So you really understand like what the appetite is for particular products. Same thing with product. You're pricing conventional, VA, FHA, and you get full price transparency by product. Most importantly, right, you can see the corporate margins, you know what's going in. So what's so interesting is a lot of times loan officers, they originate loans and they are just focused on their comp. But what they don't realize is when they go sell a loan, there's this giant basket of money. They don't really know how big the basket is, right? So they're okay taking their 100, 125 basis points, but is that really okay when there's 350 basis points in the pot? Wouldn't you want more of that? Or maybe, hey, what if I didn't, take the top part of the pot down and that's going to really improve my pricing? So, and we'll go into that on the next slide. So, and then again, like when you get to the broker, super broker world, it's all about this true interest rate, street level price, kind of the same topic. You actually know what you're competing against. You can confidently quote rates. Right. So when it comes down to like quoting out a friend or a family member, right, you don't ever want to quote, like if it's somebody, you don't want to quote a higher rate and have them come back to you and be like, why are your rates so high? Right. Because it kind of breaches the trust and there's already this implied trust between your referral source. So that's one of the things that transparency helps. And I keep pulling the curtain back. And this next slide, I think, does a really good job of giving a good visual of it. And then we'll also do just kind of a live price comparison as well. We'll just take a look at real pricing and we'll kind of show you how it works with the margin. So let's dive in just real quick in terms of like, this is another way to look at this. This is I think a great slide. If you've seen any of my transparency checks where I'm comparing rates on our pricing engine, I'll always tap into this slide. So this kind of is a really good visual for loan officers to kind of see that will show you, what actually is creating your higher rate. Okay. So on the left-hand side, brokers, and this, let's just assume every loan officer is making 150 basis points of profit. Your comp plan's 150 bips. That's why all those green boxes are along the bottom. Okay. Now, when you go to sell a transaction, it's really important. And I ask loan officers this when some don't know. I say, well, what rate sheet are you selling? Okay, loan officers will be like, what do you mean? What rate sheet am I selling? I get paid 150 basis points. No, it's like, do you know how much is the total margin, right, that's being baked into the loan that you're selling? So this is what this graph is trying to illustrate. So, for example, in here, you've got on the broker side of the house, the loan officer's making 150 basis points. And then the corporate margin is $2,500, right? So they're selling about 175 basis point rate sheet, maybe 1.875. That's their rate sheet, okay? Then you look in kind of like in the super broker Arbor world, right? You're going to see us sell anywhere between like a 200 to 215 type of rate sheet, okay? When you move into the IMB space of retail, you will see that you're selling a 325 to 350 basis point rate sheet, okay? So that kind of goes to, you kind of understand like, oh, well, I'm selling this higher rate sheet, my comp's included, but what goes into all of that, right? Why am I selling a higher rate sheet, right? Well, here's the reason why. So, at the end of the day, when you go to a kind of flat fee broker, you're not going to get any tools. You're still going to pay for accounting, LOS, some overhead, right? When you go to like a super broker, hybrid broker like us that offers non-delegated correspondent, that is a direct lender, but is also a broker. We also have a lot of marketing, a lot of tools that we give, right? We're going to have a slightly higher margin than that flat fee broker, right? So you're going to sell a 200 to 215 basis point rate sheet, right? You're still close, but again, this all comes in as a loan officer weighing the tools and the things you get. When you go to the IMB side of the house, right? You're going to be selling a 350 basis point rate sheet, right? Well, what does all that extra money go towards, right? It all goes to overhead. That all goes to the underwriters, the secondary marketing desk, compliance, brick and mortar branches. And it's a little bit different when you move down the left, as you can see, because those things shrink down quite a bit. And that's because a lot of that is offloaded to the wholesale lenders, right? It's being absorbed by the wholesale lenders, so we don't have to eat it in our price. So that should give you kind of a really good understanding, hopefully, of what is being baked into your rates. When you hear about transparency, this is what true transparency looks like. It's understanding what everything is going like. What are you selling? How much are you selling it for? And in that total pot of money that you've went and sold a mortgage to your client, and now there's this pot of money. How much do you get? How much does everybody else get? And does that make sense to you? Okay, great. So hopefully this slide has done a great job for you with this illustration of, how overhead impacts pricing. But you know what? Let me just pull up a price scenario for a real quick in our pricing engine. I want to do this live price scenario for you now. Don't worry about the date and whatnot. What it's really going to do is just show you how pricing works in a fully transparent environment. So let me hop in there now and we'll run this price scenario for you. So if you take a look at those pillars that we showed in that previous slide, this is how it relates into how it impact live rates. I know I had that red percentage sign, but look, if you're looking at like a flat fee broker, in this case, they're going to be pricing around the 6.5%. That's around the margin where loan officers are going to be able to thrive. They're going to make their full 150 basis points, and there's a little extra cheese going off to the flat fee broker. When you're looking at the hybrid like Arbor, where you're going to get non-delegated correspondent, direct lending, in-house AMC, control, docs, funding in-house, all those things, marketing, technology, you're kind of run at this little bit higher line at the 6 5/8. And again, you can see, you subtract the comp of 150 basis points, you can see what the margin is. Now, when you come in, like you saw on that sheet, when you're running for 350 basis points, and this is a scenario, you can price this out on your own. You can see that 75% loan to value, 760 FICO on a purchase. You can see you're going to be at that 7 1/8 mark, okay? Maybe 6.99 with some points, but that just goes to show you where the competition's at. And that is what you're up against. So this puts, it's one thing to obviously have the slide, but I think it's, we're loan officers, so we speak rate. And this gives you a really good illustration of why you can lose on a rate, where that flat fee model broker is, where the super broker like Arbor 6.5, 6 5/8, and then you're going to be somewhere between 3/8 to 0.5% out. If you're running on the IMB circuit. And if you're charging points at these rates, then you can work backwards. You pack even more margin in. Lastly, I put through this slide in there because one of the big knocks about transparency and about, pricing, I just wanted to, is kind of this control issue, right? People are like, oh, well, we need all this extra money. That's all the control we get because we can do our docs, we can do all of our other stuff. And this slide really shows, in my opinion, that the difference between a banker, a broker, and a super broker like an Arbor. So, it is true that when you have all that extra overhead, you get a lot more control. You can see all these boxes checked up. You get support. You get disclosures. You have your own AMCs. Everything's done in-house. You have marketing, etc. When you're on the broker side of the house, you get better pricing, but you are sacrificing a lot of these things. These are done outside of your organization. They're done by the individual wholesale lenders. which can be clunky at times. When you have super brokers that are non-delegated correspondents and hybrids like Arbor, you actually get that best of both worlds, right? That's why we were in the middle of that other slide. You get control, but you also get excellent pricing, you get support, you get marketing, etc. So, but look, hey, if you are interested in getting a more transparent snapshot of what you're selling, if you want to check your rates against Arbor, if you want to do a rate check, I'm happy to do a rate check for you. We'll have somebody in my team do a rate check. So if you're interested in having your own transparency check, if you want me to take a look at your pricing that you're getting from your bank and compare it to where we are, and we can tear into it and find out where your margin is and find out where the money's going, just DM me and I'm happy to set up an appointment with you and we'll dive into your individual needs and individual pricing requests.